XRP bulls are starting to panic as Bitcoin weakness is starting to show. We're going to talk about critical levels along with some industry experts telling us about the end of fourth quarter along with the start of 2024. You know why I'm smiling so much in this video? It's because of all of the support, the various level of support that I'm getting from you. The positive comments I've seen lately have been very uplifting, and I wanted to take a moment and say thank you. Mr. Irrigation starts us off, says, Klaus, I'm considering selling a portion of my XRP and buying some CJ Stroud rookie cards. A little bit of football action. Have you seen the recent upward swing of his Panini first look card is made? Dude looks like a vet. There are definitely some cards out there that you can make some money on. And now I watch that market as well, and that market is not breaking yet. The reason I brought this up, and thank you, Mr. Irrigation, is because we are going to talk about markets that are breaking. Shadow Moon says, Gary Gensler is so great, he deserves some subpoena. Yeah, no kidding, we're at like 2 months now, and McHenry still hasn't subpoenaed the guy. Bitcoin sitting at 36,100. Going to talk about XRP support today. ETH, under 2,000. How low will she go? XRP, at the time of recording, broke 60 cents. This is the fear that we all had. Now, some of you out there wanted to sing Kumbaya, hold hands, and start pumping up Solana some more, right? Wrong, girlfriend. She's going back down. Pumps and dumps. Heavy market manipulation suggested here with Sol. That this was an exit liquidity move. There's a lot of rumblings out there talking about it. Kathy Wood, a lot of you like her because she likes internet, tech, crypto stuff. Kathy Wood says, forget inflation. Deflation is the real enemy after the Fed went too far. Now, I'm going to share some quotes here from Kathy, and I got to be honest with you. I like to listen to people like her. Now, do I take everything she says 100% like I'm going to do it? No. But I like to listen to her as she's involved in the same kind of aspects and sectors that we're in right now. She's big into crypto, and she has a way of thinking that mimics a lot of like what we're thinking, so I like to listen. The bigger risk here is deflation, not inflation. And we're seeing more and more signs of it, Wood told the Wall Street Journal in a Tuesday interview. I actually think that investors are worrying about the wrong thing. And now, Kathy, I'm going to correct you here and say that those of us that hang out and watch the live streams, we aren't afraid of inflation. We've been watching and we've been seeing inflation tick on the way down. And what a lot of us have been worried about is that Jerome choked the economy too much, that they waited too long to start the rate hikes, and then they ended up behind the 8 ball so that it goes 75, 75, 75, 50, 50, 25, 25, 25, like, right? You get what I'm saying? So a lot of us out there are thinking he went too far. So Kathy, maybe you weren't hanging out with us in the live stream chat because those of us in the live stream chat, we've been talking about this. Wood points to fading airfare, car, and commodity prices as evidence that inflation is turning to deflation across the economy. To her point, the Dow Jones Commodity Index, a broad measure of commodity future prices, is down more than 7% last 4 months, 21% since its March 2022 peak. And Tuesday's CPI reports that showed despite UAW strike, both new and used car prices declined in October, while airfare prices sank 13% over the year. Now, the airfare prices going down is also going to tie into what everyone, oil usage. So with less and less airfare, less and less cruise ships, less and less construction, less oil usage, the oil sector will become very strong. Watch short interest in oil. And watch when short interest positions start leaving. Okay, that is going to be an indicator for oil right there. Kathy continues and says, I think the Fed's overdone it. We're going to see a lot more deflation going forward. I would not be surprised to CPI going negative at some point next year. Holy crap. Now, that's okay. What I read, though, before I went live, four rate cuts are expected in 2024. Now, let's keep learning, okay? Because remember, this is about global macroeconomics. And everything that Kathy is describing is stuff that the whole world is going through. See, when the whole world went through the whole pandemic thing, the shutdown was like everyone, right? Everyone went into this. Where in previous economic disasters that we've had, they've been very regionalized. You know, maybe the Baltic region is having some problems. Maybe China is having some problems. Maybe we're having some, UK banking issues, but it would stay fairly isolated. This is different. This is global. Listen to what Walmart said, and this is why I follow earnings reports from the bigs out there. And as always, any article you see in this video, along with all my other ones, will be linked in the description below, so you can catch up as well. Just because Walmart had a better than expected quarter doesn't mean its leadership believes it's out of the woods. Cathie Woods. Higher interest rates and lower consumer spending, for example, might be the reason for caution in coming months. Recently, we've experienced a higher degree of variability and weekly performance in between holiday events in the US, seeing a softening in the back half of October that was off trend of the rest of the quarter. So basically saying we're seeing more aggressive action happen quicker and when we aren't expecting it. This gives us reason to think slightly more cautiously about the consumer versus 90 days ago. So even the industry experts that 90 days ago were like, yo, we're going to have a juicy fourth quarter, consumer spending is going to be good. 90 days later, now they're like, yo, we're running into some problems. Now, full disclosure, I told you all in a live stream, and see, this is why you hit the notification bell and the subscribe button. I told you I was shorting US retailers. I told you that quite a few live streams ago. I'm doing pretty good, okay? This is why. It's information like this that's helping me make juicy choices. Let's keep learning because we're going to tie this more into crypto. So now you've got Walmart out there saying, you know what? Consumer sentiment's messed up. Maybe the Fed went too far. Cathie Wood thinking the same thing. All right, let's keep learning, okay? Because now we're talking about Bitcoin resistance. Why? Because when you see later, when we start talking XRP BTC correlation, they're one and the same. And it's creepy when you start digging into the data. Let's learn about Bitcoin. The firm's dissection of Bitcoin's realized price distribution points to a bulk of Bitcoin. Look, I'll sum this up for you real quick. Basically what they're saying is a bunch of people bought in between 25,000 to 31. Those people right there are the strongest chunk of support for Bitcoin. If we break through that, all bets are off the table, right? That's what he's saying. We can see a significant accumulation of coins between 25,000 and 31,000, suggesting a strong support zone around the 30,000 mark, the firm said. This is the zone that was dominated by short-term holders, where we saw a bulk of this new demand enter the market now that the price is 20% higher than its cost basis of the cluster. So you had a cluster of purchases that are now being the near-term support. And what I like here is he's referring to near-term support. He's not like, well, 2 years ago we had, no. Crypto market, there's so much turnover in it that we have to keep our focus fairly narrowed in near terms. I like this. That's why you got to be very careful on who the author of your articles are. You got to find people that know what the hell they're talking about. And what they're saying is a lot of short-term buying, a lot of accumulation of BTC in the near term at 25 to 31. That short-term support holds us at 30. We break 30, bah, don't even want to deal with it. No Merry Christmas. Now, how far do we have to go? We got a while to go. All right, we got about just under 20% for Bitcoin erosion to get us there. XRP just under 20% erosion puts us right back down at what everyone sub 50. Yeah, isn't that crazy how things are lining up? And we know sub 50 for XRP is not the fun time. That's all this right here. So let's look at these moves. Let's compare it to Bitcoin. Let's think of how Cathie Wood is telling us that the Fed has overdone it. Walmart now is saying, hey, guess what? In the last 90 days, we have to totally change our outlook here because we think it's going to be softer than expected. And we know where our support lines are. So now let's start talking price. All right, so XRP, like I said, at the time of recording, seriously, literally, right before I started recording, it was just at 60 cents, and now we're at 59.6, making a pretty strong move on the way down. Why? Because it couldn't hold the action above 70. Now, 2 times there were moves above 70, couldn't hold either. Lesser strength move than the Torres pump. Interestingly about this is, at the current trajectory that we're going, we're going to erase the Torres pump and this secondary pump that we're seeing that happened in November. Yeah, we've got a serious chance of that happening. Why? Because economic indicators, people in the know, your Cathie Woods, your Walmarts, your Bitcoin, right, researchers, analysts are saying, yo, there's some softness out there. Now, the support would be at that 50 cent mark for XRP, BTC, right around that 31,000. Both line up to near a 20% negative from where we're at right now. Now, what has me, I guess, nervous, and nervous, but nervous in a way like, why didn't more happen? Was, it looks like, hey, government shutdown, we're AGP, right? We're good to go. Okay, cool. BTC ETFs, Gensler delayed. We knew that was going to happen. The market prices, come on now. You really think Gensler was going to prove stuff? No. CPI data came out weaker, which was great. But now the problem is the market as a whole is thinking, yo, we may have overcooked the turkey. Overcooking the turkey, and if the market thinks that, you are looking at rates going down, not having any effect on the market until the lag effect shows up with the data. Now, if you watched yesterday's video, you know that we talked about the lag effect of the data with the rate hikes going forward, right? Hey, just because you hit 75 now, look, you got people that bought homes a few years ago. Guess what? They're not affected by rate hikes because they're not going to buy a new home. You got people that have bought cars last couple years, not the last year and a half, but before then. Their cars are going to last 3, 4, 5, 6 years. They're not going to buy new cars. So there's certain segments of the market that have a pretty big lag effect there in terms of development. Home loans is one of them, especially since there's not as much supply on the market. So it's keeping those numbers very messed up, right? Supply and demand metric. Now, earlier I said that it ties into Bitcoin, and here's what I want to share with you. 6-month chart up on the screen. We started in the same place percentage-wise. We are darn near the same place percentage-wise. Seriously, how messed up is that? Look at this right here. This is Taurus pump. Obviously, BTC is not going to move on a Taurus pump, right? That's an obvious action right there. We were expecting ETH to move. ETH didn't. That was kind of funky. ETH pulled on this latest move right here. Weird, isn't it? Now, look what happened here, right? XRP pumped on the Taurus news, came all the way back down, got pretty much to where BTC was percentage-wise, okay? Then you saw here again, XRP pumped again, but we're right back down to BTC time. Year to date, look, Bitcoin is above. And this is what's bugging people, is when you look at the year at this inflection point right here in November, where you've seen XRP retrace quite heavily from the highs, where Bitcoin is like, okay, we're kind of here. We're still holding on to 35,000. That's big because you want that support from Bitcoin. But now look how short-term the support for Bitcoin is above 35,000. There's hardly any of it here. It is very, very small. I mean, that is not much time built into support. Not much time at all. And look how quickly it went up from that 26,000 mark in October to above 30, to above 33. Did it within less than 2 weeks. So when we go back to the beginning and we talk about Bitcoin support, is there really that much support here with a move that was that quick? Now, we could look to the earlier support here when we got some bigger buys in June. Now, in March, that's when the bigger segments happened. This is when the banks went down, okay? When the banks went down, there was a lot of support accumulation here for Bitcoin. Here's the problem. That was all at way lower levels. That support move started at 20,000 and stopped right around 27. So below that 30 to 31,000 of that near term. Now, this is a smaller group of support. This is a bigger group of support. We break that 31, which has a small support line. We look at XRP and we're like, okay, breaking 31 puts us sub 50. We go now and we look at BTC and we're like, okay, we break 31. Our next level is going to be that mid to lower 20s. Okay, mid to lower 20s. I mean, are we looking at XRP sub 40 cents again? I don't personally look. I just don't see how we could erode that much. Economic conditions are better. I get what Wood is saying. I get what Walmart is saying. But the inflation fear is much more damaging than us just going sideways. All right? When you have inflation to worry about, you're looking at aggressive monetary policy towards the constriction of the consumer. If we get to the point where the economy is not growing at all, what do you think governments are going to have to do? They're going to have to lower rates and inject more money into global economies to get them things roaring again. What happened the last time we injected a whole bunch of money into the economy? Risky asset classes, such as heavy tech, crazy growth stuff, purple, and so forth. You know what I'm talking about. Crypto and a lot of risky asset classes moved. So yes, inflation for me was the biggest concern. Why? Because it's on a constriction style movement. If we get sideways action for a while, injection of money into the economy. Would it lead to future inflation? Well, if you inject too much, yeah. Are they going to inject as much as they did 2020, 2021, 2022? No, of course not, because we're not in that same condition. That's why I can't see it going higher than the Torres pump action in near term. Why? Because there's just not as much money going around. Would this be good for you hodlers out there? Could we get to 50 cents? Well, yeah, you better believe we can. We could easily get to 50 cents. We were just there not too long ago. Holy crap, did we go deep in the weeds there. And I think that's what we're all starting to do right now. We're all starting to look at as much economic data as we can, and not just from the United States, but globally. That's why earlier this week I brought up the big dates, the global big dates regarding CPI and so forth. Going to start paying attention to global Fed, right? Central bank rate decisions as well. Now, when these Fed banks and central banks start lowering their rates, that's good. But remember, we're so freaking high that even if we lower a little, we're still crazy high compared to what the consumer was used to down here not too long ago. That not too long ago point I'm bringing up is because not too long ago, BTC got a big chunk of support around that 30,000 mark. But it wasn't long lasting, so the support is soft. XRP, as I've shown you, is basically moving with BTC here in the near term. Yes, BTC is avoiding the Torres pump because BTC is not a freaking security, it's a commodity. So obviously they're not going to get any relief on that. BTC already had its protection. The recent pump with XRP and a little bit of BlackRock fake news, well, I mean, come on, pumps and dumps, let's be real here, put us right back down to yes, along with Bitcoin. So in the last 3 months, if XRP is overall following the trend of Bitcoin, we have to pay more attention to the Bitcoin support. We have to pay more attention to Bitcoin news, not because we're crazy like Sailor and we sleep with a Bitcoin teddy bear. Crazy, isn't it? And hold on. For those of you out there that have been asking, my main man Patrick's going to come back and say, imagination. That's right, Sailor. Crazy guy. But we're going to pay attention to BTC and the support there. For those of you out there looking for stacking opportunities, you can eye 50 cents up pretty easily in my opinion, honestly. This last move I don't think should have happened. It looked like a run up on BS, and then it looked like an exit liquidity move. Plain and simple, especially when we found out, and yeah, we did find out, that the BlackRock ETF news was fake. And that now the Department of Justice is going after someone to pay a little bit of penalties. So let's keep watching global macroeconomic data. And let's see if we get to that point where Walmart, Cathie Wood, and other global leaders out there are saying, hey, look, the biggest concern is not inflation anymore, but Fed, you may have gone too far and overcooked things. I'll leave it with this. I've been doing this now on YouTube for several years. I've done, oh my God, I think 2,000 videos at this point. It's crazy. And I can tell you that when all of this was happening with the pandemic, whatever you want to call it, that we were sitting there watching together on the live streams. There's some OG viewers that are still hanging around, and thank you for that. And thank you all the new viewers too. But we were watching on those live streams with Jerome Powell several years ago, saying, dude, you have to start raising rates. And he would always be like, we're not ready to raise rates yet. We're waiting to make sure that we're in a good position because we don't. And we're all sitting here going, dude, you got to raise rates, man. And the next meeting he would come out and he'd be like, we're not going to raise rates. We're not going to stop our we're not going to start quantitative easing. We're not going to start changing our balance books. And we're all like, what are you doing? We're going to get crushed by inflation. And then Jerome's like, inflation is going to be transitory. And Yellen's out saying inflation is going to be transitory. Nothing to worry about. It's going to go back down naturally. And we're sitting there and we're freaking out. And we're like, oh my gosh, dude, you are going to kill us. You are waiting way too long. What the hell are you doing? We watched another meeting and Jerome's like, we're not going to do anything yet. The economy is going good. We need to keep injecting money into the economy, blah, blah, blah. And we're all sitting here screaming at each other in the live stream going, you idiot, what are you doing? So then what happens? 75, 75, 75. Never have we ever seen that in history. The most aggressive rate hike we saw in 40 years. So they waited too long, and now a lot of us are thinking they did too much. Jerome, my parting words are going to be directly to you, sir. Next time, stop worrying about political help. Stop worrying about trying to please your political partners and do what's best for the people. A lot of us watching on those live streams knew we should have started raising rates sooner. We were all saying it. We weren't calling for the 75, but we were at least saying, hey, drop at 25 to at least tell the market that you mean business and that we're going to fix things. Government, we have to raise rates because of your inaction regarding supply chain stuff. But it didn't happen. So, Jerome, I will tell you this. Instead of waiting to see if you've overcooked it, how about you tell the market something that gives them a little bit of positivity? So that the market isn't going to sit here and think that you choked us for growth for the next 3 to 5 years. Yes, everyone, that's how long the ripple effect for this current move is going to last at the rate that we're at. The sooner we start admitting that we're going to pause, this is it, this is the max, and then we can drive stuff down, that window of time shrinks. But right now, you're at 3 to 5 years of pain from the Fed's inactivities. And remember, central banks across the globe take cues from the Fed. They literally go, did you see that Jerome Powell and the Fed raised rates? We're doing the same thing in our country. And they do it. So if they're like, you know what, Jerome Powell says that things are okay, things are strong, we're good to go, we don't need to raise rates yet, they do the same thing. So Jerome, you caused a lot of pain in my opinion. Speaking of pain, I got a recovery run to do today because I overcooked it with my speed workout a little bit. Recovery drink, ice in the hammy, my left hammy, and my knee. What are you cool cats doing? Let me know in the comments below, and I'll catch you all later. Probably later today.